Well, welcome back to the U.S. where we have high interest rates and a strong dollar. One of the things that you told me yesterday, which I thought was very interesting, is that you were getting paid in U.S. dollars. You make a lot of money in U.S. dollars, and then you're paying your salaries in Colombia.
Almost all my expenses.
Yeah, and I thought that was an interesting perspective. Can you chat a little bit about that and how the difference of what's going on in our economy right now with these Fed increases and high inflation?
Yeah, most people look at this from a standpoint of their expenses being denominated in U.S. dollars. So they look at the 10-year Treasury as an example, and they say, well, my gosh, who would buy that at 4% when the CPI is at 8%? Because you're guaranteed to lose 4% per year in purchasing power. So no one would buy the long end of the curve.
Right.
But what they don't understand is the dollar is appreciating so significantly against other currencies that for foreign investors, that makes a lot of sense.
Right.
So like in my case, most of my expenses are denominated in pesos. And over the last maybe 6 months, the peso's gone from, call it 3,600 to 5,000.
Yeah, that's a big
$1. $1. So my payroll, although I have more people working for me, has actually gone down significantly. I mean, I go out to dinner now. I go out to all these things, and it's always been extremely cheap.
Yeah.
But now it's laughable. So, and what's weird is we're living in a world that's experiencing inflation, very similar to what we saw in the 1970s, because it's not necessarily a U.S. phenomenon. We see it in Europe, we see it in Japan, we see it even in Colombia and all these other places. But yet, I'm in this weird position, and you can engineer this if you have the resources to do so, where you're living in an inflationary world, but yet in your own particular circumstance, you're receiving the benefits of deflation.
Well, and we hear a lot about them trying to fix inflation, right? And if they can't get these oil prices and energy prices down, no matter how much they hike rates, we're still going to have an inflation issue. Is that correct?
That's a very complicated question, because you've got to look at it through the lens of Milton Friedman. And in the 1970s, when he came out and says inflation is always and everywhere a monetary phenomenon. So you're correct that oil or fossil fuels is pretty much an input to every single thing that we buy. But if you don't increase the money supply, you're robbing Peter to pay Paul, right? So you've got some things that you buy where the demand is very inelastic. Let's just say the things that you need. And then there's some things that you buy that you don't need. So you could go into this world, I call it inflationary deflation, where the stuff that you need is going up in price, but the stuff that you don't need goes down in price. You see, because even though those input costs are higher, you're just getting all these businesses that are going bust because people just flat out don't have the money.
Mm-hmm.
Now, does that create an environment where the prices come down in aggregate total? That's where your question gets very, very complicated. I mean, we just were talking yesterday about how the builders, that you guys were talking to, they've got a lot of deals in the pipeline, but after that, they're done.
Right.
You see, and they've had to raise their prices because of their input costs. So if the people, their future customers, can't afford their higher prices, they can't lower them because their input costs are what they are.
Mm-hmm.
And so they just can't do the deals. They have to fire everybody. And so does that create the prices coming down, or does that mean that there's fewer businesses that are providing that service to a smaller group of people that can still afford to pay the higher prices? See, that's why I'm saying it's very nuanced and complex.
I know yesterday we were talking, George, about, everybody's concerned about these rises in this interest rates. We had 6 now since March, and we got another one potentially in December, and maybe even more in 2023. But you said something very interesting. You said that doesn't mean that you're still going to get a loan.
Right.
In other words, when rates maybe go back down, which is what everybody's waiting for, there are other issues and other things that people don't think about. Can you talk a little bit about that?
Sure. You got to ask, why are the rates going down?
Yeah.
People just assume that the rates are going to go down because we're going to have this nice soft landing and the Fed's going to just magically find the right number for interest rates, and the CPI is going to go from 8% to 7 to 6 to 5, right back down to 2%, smooth sailing, and we're off to the races again. But what you see historically is that's never happened.
Yeah.
Or maybe a couple times, but that chart I had.
Yeah.
That I showed you going back
Incredible
to the
chart.
1970s.
Yeah.
When the Fed hikes rates, when they pivot, you don't just have a nice smooth sailing. Usually that's when the market crashes because there's a lag effect.
When there was a pause, you said.
That's right. There's a lag effect to the rate rise.
Yep.
Right, or the rate increases. It's like my buddy Adam Taggart, someone we know well. He calls it the pig through the python. And so that interest rate is that pig going through the python, and it goes very slowly. But at a certain point, then the impact is felt by the real economy to a point where it really matters with nominal GDP or real GDP, and then you get a significant recession. It could be a garden variety recession, and that's what the bond market is telling us. And I would argue the stock market still comes down, and residential real estate in nominal terms probably still comes down a little bit, definitely in real terms. But is that this black swan event that would create an environment where money would be tight? I don't know. But you go back to COVID, or you go back to the GFC, and we know that they dropped rates right away. But good luck trying to get a loan on residential real estate, as an example, in 2009 or 2010, even though the interest rates were super, super low. People associate low interest rates with loose money.
Yeah.
And often low interest rates are an indication of tight money, not loose money.
Inflation hasn't moved at all. And it's been, since 6 or 7 months now. Do you feel like next year we're going to start to see that lag kick in?
Yeah. And you got to ask yourself what created the inflation in the first place. So it was too much demand, not enough supply. So you say, have we fixed the supply side issues? Not really. I mean, those supply chains that were destroyed globally by all these lockdowns, those haven't been fixed. They're not back to where they were in 2019. And you say, okay, what was the demand side? Well, that was all the stimulus checks that went out. And if you look at the average checking account balance of Americans in 4 or 5 different income brackets, each income bracket still has more in their checking account than they did in 2019. So you've got more demand, excess demand, right? That has not worked its way out of the system, even though the stimmy checks went out, a year and a half ago, because there was a lot on the expense side that equaled more money coming in as far as their, like not having to pay the rent, student loan forgiveness, all these things, maybe not having to pay a mortgage. So it wasn't just more money, but it was fewer expenses, which lead to a higher checking account balance. And that higher checking account balance has gone down and down and down and down. The problem that you have there is at some point you will get back down to where you were in 2019, but unfortunately it won't stop. The checking account balance will continue to go down. Why? Because we've had significant inflation and wages have not kept up with inflation.
Exactly.
So the purchasing power, even though their wages are higher today than they were in 2019, they have less purchasing power. So their checking account balance is going to get down to where it was, and they're either going to have to tighten their belt and spend less than they were in 2019, or their checking account balance is going to get down to zero. And that's when you have a real contraction in aggregate demand, which would most likely be, push prices down. Now, it's not to say that we have deflation, but it's to say that we have disinflation. So if we're running at 8.3 now, then it goes down to 7 to 6 to 5, something like that. You say, well, great, that's what the Fed wants. Yeah, it is, but that means that we're going into a very, very significant recession when you see the unemployment rate go from 3.7